At Simplify, we've been super fortunate to have great partners all along the step of the way. We founded the company in 2010. We raised a seed round, had a great partner in our seed round in Progress Partners, actually, who was very active in helping us, sort of in the early formative stages of the company, giving us introductions, et cetera. About 3 years in, we raised a growth capital round, and a company called Frontier Growth down in Charlotte came in. Really a fantastic growth investor for us. Made us focus on some metrics that we weren't necessarily focused on, really SaaS type metrics like net recurring revenue, as well as our NPS score, and really set us up for the next stage. And then in 2017, the growth investors had seen a good return. They wanted to monetize that return, and so we went out and looked at sort of who would be the right owner of the company going forward. We talked to strategics, but we really, I think, hit a great place where we're introduced to a private equity firm named GTCR out of Chicago, and they acquired the company along with management in 2017, and they have been really a fantastic partner for us, really building, helping us build the foundation to grow the company to the next stage.
So Frost, tell us about selling to private equity, why that was a good, move for you guys, some lessons learned, and to share with other executives who are looking to exits and looking to growth, and why private equity.
Selling to private equity was a great fit for us because we really believed in the company and wanted to participate in the company in a meaningful way going forward in the growth of the company. So we were at that time a little small to go public. There was an opportunity to sell to some strategic partners where we'd become a division of a larger company. But really we saw the opportunity to continue to grow the business independently, and for management team, including myself and Paul Harrison, my co-founder, to continue to participate in that growth. And that's why private equity and really bringing on our board as owners, really smart, very, very smart investors, and who understood the industry and understood really how to help us create value in Simplify.
What does the journey look like after the acquisition from private equity? Not necessarily for you, but for other companies, in terms of being incentivized, being there, a potential exit. What does that journey look like? What do you hope your journey looks like?
So when you sell to private equity, you're really going into partnership with that private equity firm. So the management team is going into partnership, and really need to come together on how together will we create, or the company is going to create value. And that can be done a number of ways. It could be done by just straight organic growth, improving the operation, investing in more development, investing in more sales, being very strategic about how you grow. Or it could be done by acquisitions, right? So private equity firms typically have capital to deploy, and perhaps the best way to grow the company is to go make some strategic acquisitions, as we have recently done. But it's really coming together on how to drive value creation as we go, and bring on a smart partner to do that. And then once you create that value, private equity firms are in the business of delivering capital back and delivering those returns back to their investors. So it'll be really, after some period of time, 3, 5, 7 years, they'll want to look for some way to monetize that investment and get that capital back to their own limited partnerships or limited partners.
Now, for us, let's sort of taking off your Simplify hat, but sort of looking at the industry, there's quite a lot of activity in the public markets, up and down, good and bad. It's kind of it's hard to track from day to day, but there's certainly a lot more interest in IPOs. There's a lot more deal making going on. What's your thought about deal making, IPOs in the public markets for ad tech firms, and how do you see things going, and maybe advice you might have for companies who are considering it?
Right. So the public markets have had a kind of love-hate relationship with the ad tech industry. Early on, there were some companies that went public and didn't perform well in the public markets, and that, I think, soured the public markets for a while. But more recently, of course, we've had the industry's matured. We've got great companies out there like The Trade Desk who have shown that ad tech ad tech companies can be good public companies. And more recently, we've had additional companies that go out. And so these are companies that are growing well, that are profitable, and that have great prospects going forward. And so that's why all of a sudden the public investors are saying, wow, are there more companies like that in the ad tech space that could be good public company investments? And so that's why we're more on the love side than the hate side, because we have more mature, profitable, growing companies that are performing well in the public markets today.
And finally, for those really starting out or in the early stage entrepreneurs who are sort of have a great idea, what is some of your advice about getting seed investment? Who to find, how much to give up, how to network around? Any thoughts you might be able to share?
Yeah, so for people starting out, I mean, the quality of the partnerships is really important. As I mentioned, we've been super fortunate to have great partners all along, from the seed stage to the growth stage and now in the private equity stage. And so those partners you have can either bring on and add a lot of value, or if they're bad partners, they could be a big distraction. And again, so we've been super fortunate to have very supportive, smart partners that have helped us grow the company. And then I think the other thing, at least from our perspective, is we were focused on being profitable fairly early. So when we went to raise money, it was really because we wanted to raise money to fund growth initiatives. It wasn't because we needed to raise money to fund losses, and we had a gun to our head where, hey, if we didn't raise money by a particular time, bad things would happen. So I mean, the advice from that perspective was really look for a way to get, at least what's worked for us, and different companies have different paths. Really, we looked for a way to get profitable sooner rather than later. And so we could choose the type of fundraising we wanted to do and be opportunistic about that, as opposed to being forced into it to cover losses that we were generating. But I think all in all, I mean, I think the partnerships matter, of course, not only from the investor perspective, but the key, really focusing on the early personnel you bring on. Make sure you've got great hires, and make sure that you've got plan to motivate and incentivize your people. We've been super fortunate, at Simplify, to have a great team with us, and that's really made all the difference, both to the company and, frankly, to me personally, to be able to work with a team like we have.